What's going on, everybody? Liam O'Reilly, Vermont economic realtor with Jerry Riley Real Estate. I hope you're doing well. The Federal Reserve is taking money out of the hands of businesses who are relying on debt. They're taking it out of consumers and they're giving it to banks, which I think is a way to prep for a potential recession when they eventually do lower rates as their rate hikes and their quantitative tightening eventually hits the economy. Now, I want to go into this and I want to go into the repercussions and what this means for the next 18 months or so when all these things potentially go into effect. Now, I'm stepping a little bit outside of my comfort zone. I haven't heard anybody else talk about this. This is, my own theory. So let me know what you guys think in the comment section below, and let's get right into it. So, if you've been paying attention to the Federal Reserve at all or the overall economy, you know that they've been hiking rates over the past year. If we take a look at their most recent rate hike here, rates are now at between 5.25 and 5.5%, and this is their overnight lending rate. So essentially, that's when banks and other institutions keep their money at the Federal Reserve. They get paid a guaranteed annualized rate of between 5.5 and 5.5%, and they get paid overnight. So it's a very reliable, very safe investment for banks, and that's what the Federal Reserve does when they hike their rates. Now, at the same time, as most of you know as well, the Federal Reserve has been reducing the size of their balance sheet. If we go over to their balance sheet here, we can see that basically since 2022, when they started hiking rates, they also started reducing the size of their balance sheet. So essentially, they're doing this in an attempt to hike rates and take money out of the system to get inflation down. Right, when the Federal Reserve doesn't purchase assets, they're not manipulating the overall interest rate economy, or interest rate market. What they're doing is letting the market function on its own. So that's what's going on. That's something that most people know. So what are the repercussions of this? Now, if we look at M2 money supply, we obviously see that they've been taking it's caused money to come out of the system. People are losing money. Now we've seen a slight uptick in M2 money supply recently, but for the most part, it's been a downward trend since the Federal Reserve started this path of hiking rates and reducing the size of their balance sheet. So how is the Federal Reserve giving money to banks while, quantitative tightening, while reducing lending in the overall economy? Well, essentially they're losing money. So when they're reducing the size of their balance sheet and increasing rates, the Federal Reserve is guaranteeing that they're going to pay the people who have their money in the overnight lending facility. And I say people, it's mostly banks who have their money in the overnight lending facility of 5.25 to 5.5% rate. Although they're reducing the size of their balance sheet, which is reducing the amount of money they're taking in, they are still paying that guaranteed interest rate out to banks. And as a result, the Federal Reserve is losing money. Now, this is just a Google search of the Federal Reserve losing money, and these articles are all from the beginning of the year. You can see this one is February 2023. The one below is March of 2023, March of 2023. So the federal, nobody, at least I haven't been able to find any recent articles about this, and this is something that people aren't really talking about. But in February, you can see the top headline there. The Federal Reserve was losing about $2 billion per week. Now, that was back in February. Since then, the Federal Reserve has continued to hike rates. Now rates are at that 5.25 to 5.5%. So they're guaranteeing that they're paying more money out to the people that keep their money at the overnight lending facility while they've reduced the size of their balance sheet. So they're taking in less money than they had before. So this causes the Federal Reserve to essentially lose money and be insolvent. Now, if you think about this from a perspective of an individual, right? If an individual doesn't have enough money to do something to pay their debts, then they'll need to borrow money to get what they need, right? If you don't have money to buy a car, you have to borrow money to buy that car. Now, with the Federal Reserve, if they don't have money to pay the interest that they're guaranteeing in the overnight lending facility because they don't have the revenue coming in from the assets on their balance sheet, then they just borrow money from themselves. They don't have to go to anybody else, to a bank or to any other institution, and ask to borrow money. But when the Federal Reserve borrows money and when they lose that money, when they lose that $2 billion per week, essentially what they're doing is they're creating money into the system because they're taking money that doesn't exist, money that they don't have, and they're giving it to banks. They're giving it to the institutions that hold money at their overnight lending facility. So they're running at a deficit and they're spending more money into the economy than they have. So what they're doing, right, just to recap everything, they've hiked interest rates to 5.5 or 5.25 to 5.5%. That's what they're guaranteeing to take out. They've reduced the size of their balance sheet. So they're taking in less money and they're paying out more money than they did in the past. So what are the effects of this? When the Federal Reserve is losing money and they're creating money and putting it into the system, where that money goes is to the people that have their money in the Federal Reserve's overnight lending facility. The people that are benefiting from this are not the institutions that are relying on debt because they are paying a high interest rate, which they might not be able to service. If you made your business based on revolving debt at around a 3% interest rate, where rates were the past few years, now that interest rate is probably closer to 10%, which means the debt that you're paying to service your business is much higher. And obviously, you can clearly see this in the real estate market where mortgage rates are much higher than they were in the past, which makes things a lot less affordable. If you think about it from a real estate investment standpoint, if you're going to buy a rental property, then the money that you're borrowing to purchase that rental property is more expensive. So you might not be able to service the debt of that rental property, and you would be forced to sell or be in foreclosure, right? If you're paying more than you're taking in with income, you're not the Federal Reserve, and you can't just borrow money indefinitely from yourself and use that to pay your obligations, then then you're going to fail as a company. So what I think the Federal Reserve is engineering right now is the companies that are insolvent, not necessarily just real estate companies, people that invest in multifamily properties or things like that, but companies who are reliant on debt to service their business, to pay their employees, and are not bringing in enough revenue to cover that debt, eventually they're going to fail. They are most likely being stressed right now by the higher interest rates because their debt payment has increased substantially over the past year. At the same time, the Federal Reserve is making new money and giving that to banks who are potentially solvent. I'm sure some of them aren't solvent, like we saw with Silicon Valley Bank, but the ones that are in good shape are able to take advantage of the overnight lending facility. They're able to take advantage of these higher interest rates, and they're able to stockpile reserves because of these facilities that the Federal Reserve has set up. Now, if we think about the most recent Federal Reserve press conference, we get a sense of what this could mean for the economy, for lending going into the future, and potentially real estate going into the future. So the Federal Reserve said in their last press conference that they're most likely going to lower rates at some point in 2024. And I'm not going to play the video for you folks on this channel, but I'm going to leave this link in the description for you folks. And I would recommend watching at least this section of the video. If you go to 40 minutes and 12 seconds, somebody's in the middle of asking a question. If you just listen to that question and listen to Jerome Powell's answer, I think it'll be very revealing for when the Federal Reserve is going to lower rates, at least when they think they're going to lower rates. The question that was asked was, is the Federal Reserve committed to keeping rates high until inflation gets down to 2%? And what Jerome Powell said is that they expect inflation to be down at 2% at some point in 2025. And if they were to wait until inflation was down to their 2% target level, if they were to wait to lower rates until inflation was down at that 2% target level, then they would have waited too long. They would have over-tightened. So Jerome Powell and the other economists on the committee expect that rates will be lowered at some point in 2024. Now, how does this play into everything that we've been talking about? Basically, these banks that are flush with cash, I'm sure this isn't every bank. I'm sure other banks, there are some banks that are really struggling and aren't flush with cash, as we've seen in recent months. But the banks that are flush with cash, the banks that have been able to take advantage of this overnight lending facility and the higher interest rates, will be looking for a place to put that cash when the Federal Reserve eventually does lower their interest rates once inflation gets down to whatever level they deem as acceptable. It doesn't really matter what level it is, but eventually, as Jerome Powell states, rates are going to come back down. The Federal Reserve is going to lower their target funds rate. The banks that have extra cash on hand are going to be looking for places to put that cash to generate a return, right? If you can no longer get that 5.25% to 5.5% guaranteed return from the Federal Reserve, and if presumably the Fed lowers rates, then presumably treasuries will, the treasury yield will come down as well. They're going to be looking for other places to get their return. So what I think could happen over the next 18 months here is that these companies that are relying on debt, companies that have overstretched themselves, are going to fail. potentially as designed by the Federal Reserve. And then as those companies fail and the economy experiences hardship, the Federal Reserve is going to drop rates and start quantitative easing. And then these banks that are well positioned and have excess cash on hand will be able to take that cash and put it into the economy to generate returns that they want to get, to generate the returns that they want to see. So what I think could happen over the next 18 months, based on the situation that we're looking at, if we just think about this data, that a lot of these businesses are going to fail. The Federal Reserve is going to lower their interest rates, and then banks and lenders are going to be ready to put that money into the economy and get a reasonable rate of return off of that. Now, when I say put that into the economy, that could be in a variety of forms. It doesn't have to just be real estate. It could be small business loans or commercial loans, something where they can get a solid return off of their money. But it also could be into mortgage-backed securities, which would help lower the mortgage rate and potentially stimulate the housing market. Even though we might see businesses failing, we might see unemployment rise. What we could see, potentially in 2024 here, is an increase in lending availability. The lending standards that have been tightened as of recently because of the Federal Reserve's actions could start to loosen up, and we could see that money flow back into the economy and start to stimulate things again. At least I think that could be a strategy that the Federal Reserve is using, and I think it's reasonable based on the data, right? If the Federal Reserve is losing money every week, which is essentially printing money, giving it to these banks should have more money to lend out into the economy when the rate of return on these safer investments goes down. I think it's a little tough to say how you should use this information to position yourself moving into the future, but I think it is something that you should consider. I think it's a valid point. It's something that nobody else is talking about. At least I haven't heard anybody else talk about it. And obviously there's not many articles being written right now about how the Federal Reserve is losing money and what the implications of that are. And I think this is, what I just outlined is one of the potential implications of the Federal Reserve losing money. So be prepared in 2024 if lending standards do loosen up to take advantage of that and use it to potentially prosper yourself, as we might see other businesses and potentially the economy being in a tough place at that time. So anyway, Lee Morale, Vermont Economic Realtor. All my contact information is in the description. If you have any real estate needs in any state, reach out to me directly and I will find a way to help you. Leave me a comment. Let me know what you think. Do you think I'm spot on about my assessment of what the Federal Reserve is doing and where the flow of money is going? Do you think I'm wrong? I would love to know your thoughts. Other than that, I will see you in the next video.